4 million used sailing boats have suddenly overwhelmed the market, sending shockwaves through the entire industry. Dealers who prospered in the pandemic boom now face financial ruin, and boat owners watch their investments crumble as resale values collapse by as much as 40%. How did skyrocketing demand just a few years ago spiral into this unprecedented flood of inventory, and who stands to lose the most? In the spring of 2020, as lockdowns swept across the country, the boat industry saw a rush unlike anything in recent memory. Families who had never considered owning a boat found themselves searching for safe escapes, and marinas filled with first-time buyers eager to spend on outdoor freedom. Sales figures soared, nearly 320,000 new boats sold in the United States that year, a surge of about 40% over 2019. Dealers reported empty showrooms, and waiting lists for popular models stretched for months. The used market, too, saw over 1 million boats change hands in 2021, with pre-owned listings snapped up at a record pace. The easy money flow fueled this boom. Banks and credit unions, eager to capture new business, rolled out marine loans with historically low interest rates, often below 4% for qualified borrowers. Loan terms stretched to 15 or even 20 years, and average principal amounts crept above $75,000 for new sailboats. For many, the monthly payment felt manageable, and low rates masked the true size of the debt. Industry analysts watched as first-time buyers made up nearly a third of sales, a dramatic increase over previous years. Some buyers financed not only the boat, but also trailers, electronics, and slip fees, taking advantage of flexible lending standards that would have been unthinkable just a decade before. Manufacturers responded with confidence. Production lines ramped up, and companies like Group Beneteau and Hansa Yachts AG set ambitious targets, betting that the demand would last. Dealers, flush with orders, took on extra inventory through floor plan financing, expecting that the wave of new buyers would continue. The total United States boating market value jumped to $49.3 billion in 2020, up 14% from the year before. Marine finance companies reported a 35% rise in first-time boat owners between 2020 and 2021, a sign of how deeply the pandemic reshaped consumer behavior. By 2022, however, the first signs of strain appeared. Interest rates began to rise, and the flood of new boats entering the pipeline showed no sign of slowing. Dealers and lenders, buoyed by recent sales, continued to approve loans and order inventory at a pace set by the extraordinary demand of the previous 2 years. But as economic uncertainty grew, the gap between expectations and reality widened, setting the stage for the market to absorb far more boats than it could ever hope to sell. Factories kept their assembly lines running at full speed through 2021 and well into 2022. Group Beneteau, Bavaria, Hansa Yachts, and other major builders set record output targets, signing contracts with suppliers that locked in months, sometimes years, of production. These commitments could not be paused without steep penalties, even as signs of cooling demand appeared. By late 2022, dealer lots across the US and Europe filled with new sailboats shipped in anticipation of orders that never materialized. Warehouse space ran short. Some dealers, bound by non-cancelable supply agreements, took delivery of inventory they could not move, hoping the market would rebound. The financial burden grew heavier each month. Most dealers relied on floor plan financing, a common industry practice where banks or captive lenders front the money for inventory. As long as boats sold quickly, interest payments stayed manageable. But rising interest rates in 2023 changed the equation. What had started as a cost of a few percent per year ballooned to double digits. For a dealer carrying $5 million in unsold boats, annual interest alone could exceed $500,000. Every unsold hull became a liability, not an asset. Manufacturers, meanwhile, found themselves with backlogs of finished boats and parts. Union labor agreements and supplier contracts made it difficult to slow or halt production. Some factories kept building simply to avoid breach of contract penalties, even as storage yards overflowed. Industry insiders describe a scene where new boats, some still in plastic wrap, sat in off-site lots for months. In rare cases, manufacturers began scrapping unsold inventory because storage costs outpaced the value of the boats themselves. Dealers caught in this squeeze faced a dilemma: keep paying ever higher carrying costs, or slash prices to move inventory at a loss. With lenders tightening terms and demanding faster repayment, many had little choice but to liquidate. The glut of new and nearly new boats on the market set the stage for a wave of distressed sales, and the pipeline of unsold inventory ensured that the market would remain flooded for seasons to come. In early 2023, the first cracks appeared in the financial system that had powered the boat market's historic boom. Dealers who once relied on floor plan credit to stock their showrooms found themselves under mounting pressure from lenders. As interest rates climbed, banks and finance companies began issuing curtailment notices, demanding that dealers pay down 20 to 50% of their outstanding balances within as little as 30 days. For many, this meant finding hundreds of thousands, sometimes millions of dollars, almost overnight. Dealers in Florida, Michigan, and California were among the first to default. Internal memos from regional banks reveal a wave of margin calls, with lenders tightening audits and demanding immediate repayment for any missed remittance or covenant breach. Some dealers tried to hide unsold inventory off-site, hoping to avoid triggering further curtailments, but the numbers were impossible to disguise. In one case, a 50-year-old dealership in Mystic, Connecticut, received a final demand for $2.4 million in curtailments. Without the cash on hand, bankruptcy was the only option. The layoff letters went out, and the entire inventory, hundreds of boats, was consigned to auction. Lenders moved quickly to recover their collateral. Boats were repossessed in bulk and funneled into regional clearinghouse auctions. At a Fort Lauderdale sale in March 2024, more than 600 sailboats changed hands in a single day, many at less than half their original invoice price. National dealer representatives, auction flippers, and international buyers competed for bargains, while banks and floor plan lenders accepted deep losses just to clear the books. The same week, online listings for similar models across the country dropped their asking prices by 15% or more, as market algorithms and desperate sellers raced to keep pace with the new reality. The pace of liquidations only accelerated. By the end of 2024, more than 4 million boats, new, nearly new, and aging trade-ins had hit the used market, a spike confirmed by a surge in listing data, bankruptcy schedules, and lender reports. The sudden flood of inventory overwhelmed buyers, and what began as a dealer crisis quickly spilled over into every corner of the boating ecosystem. Used boat values fell sharply as the market flooded with inventory. By late 2024, average prices for sailboats dropped between 20% and 40% from their mid-2023 highs. Models that once sold for $120,000 struggled to fetch even $68,000. For many owners, the numbers no longer made sense. Loan balances often exceeded the value of the boat itself, trapping families in a cycle of payments on an asset they could not sell or afford to keep. For one couple in the Midwest, the impact was personal and immediate. They purchased a new Catalina in 2022, financing $120,000 over a 15-year term. When the market turned, the boat's value collapsed to $68,000, leaving them more than $50,000 underwater. Their monthly payment now eclipsed their home mortgage, and insurance premiums had doubled after their policy came up for renewal. They faced a painful choice: keep paying or sell at a loss that would wipe out years of savings. "We thought we bought a dream. Now it's an anchor pulling us under," the husband explained to a local reporter. They listed the boat for sale, but offers came in far below their remaining loan balance. In the end, they accepted a deep loss, just to escape the mounting costs. Stories like theirs played out across the country. Owners who bought at the peak found themselves unable to cover slip fees, repairs, and maintenance. For boats over 15 years old, insurers often refused to renew policies or demanded premiums that made continued ownership impossible. Some owners tried to walk away, only to be hit with deficiency judgments after repossession and resale. Others faced a new problem: disposal. Municipal landfills and boatyards reported a surge in abandoned hulls, with fiberglass boats piling up faster than they could be processed. Local governments struggled to keep up, and debates broke out over who should pay for the cleanup. The collapse reached far beyond individual owners. As maintenance and storage costs outpaced resale values, thousands of boats became financial liabilities instead of leisure assets. The sudden reversal left communities, lenders, and families reckoning with losses that stretched far beyond the docks. Today, thousands of boats sit unsold, their values adrift in a market still searching for equilibrium. As credit tightens and inventory lingers, the boating industry faces a reckoning that echoes across all luxury markets. The real test now: who adapts and who gets left behind? Share your thoughts below.